Welcome to Kalkine's educational series. The topic for the day is interest rates. To begin with, let's understand what are interest rates. Interest rate can be defined as the amount a bank or a lender charges to the borrower for the use of its assets or money. The rate a bank pays to its depositors for keeping money in a savings account, recurring deposit, or fixed deposit is also termed as an interest rate. Interest rates are frequently charged for mortgages and personal loans, along with loans for the purchase of buildings, cars, and other consumer goods. Besides, corporates also take business loans from the financial institutions based on prevailing interest rates. While the term interest rate is used in multiple domains, including cost of borrowing, return on investments, and return on savings, it is primarily known for the rate charged by central banks on its loans and advances to commercial banks. The cash rate further stimulates the rate charged by commercial banks on consumers' borrowings and saving deposits. In an economy, interest rates are broadly classified as nominal and real interest rates. While nominal interest rates represent the rate of return to be paid by a borrower without any adjustment for inflation, the real interest rates take inflation into account and reflect the real cost of funds to the borrower. Now let's understand how are interest rates calculated in general. The lenders or banks use two different kinds of interest rate calculations. Simple interest being the first one. Such interest is calculated on the principal amount of a loan or deposit using a basic formula. Simple interest is equivalent to P into R into T, where P stands for the principal amount, R for the annual interest rate, and T for the term of the loan or deposit. Let's understand this via an example. For instance, if Mr. Mark Breeze borrowed $5,000 for 3 years at the rate of interest of 2% per annum, the simple interest will come out to be 5,000 into 0.02 into 3, that is $300. The second sort of interest rate is the compound interest. Besides simple interest, the compound interest is also deployed in different situations. Compound interest is calculated on the basis of both principal amount and the interest that compounds and accumulates over the principal amount. The formula for computing compound interest is P into 1 plus I raised to the power n minus P, where P is the principal amount, I is the annual interest rate, and n is the number of compounding periods for a year. Now let's understand this via an example. Consider a person who deposited $10,000 into savings account at a rate of 2% for 3 years, compounded annually. The compound interest in this case will stand at 10,000 into 1 plus 0.02 raised to the power 3, that is 3 for the number of years, minus 10,000, which is equivalent to $612.08. We hoped you liked the session today. For more updates and more information, please visit our website kalkinemedia.com and do subscribe to our YouTube channel.